I'm sure the audience, they can kind of infer what you're talking about. What you're talking about is those big AI players. You have a lot of confidence in them. They have these tools that many companies believe can drive down their cost of labor, also improve productivity. But right now you're saying we've seen the rally in the headline AI players. Now it's time to look at basically what the picks and the shovels are of this AI gold rush, just to keep the metaphor going. You have some interesting stats. So you say because of AI, we're going to see a huge replacement cycle. More than $1 trillion for data centers alone. Explain to me what kind of stocks are going to benefit from this replacement cycle when it comes to artificial intelligence?
Absolutely. So, I mean, what the key message from earnings season so far has been that demand for AI infrastructure is not going away. We've seen this in the hyperscaler capex numbers. These were sensational numbers. Meta, Microsoft, Google, they collectively increased their capex expectations for the year by 10 billion in just Q1. Now, this elevated capex spend is a major support for the growth runway for leading companies in AI infrastructure. So Nvidia, the most obvious example here, but they're certainly not the only company. We heard from Arista this week. They reported blowout numbers. Now, they provide the Ethernet networking for the likes of Meta and Microsoft. Actually, 40% of their revenues are directly tied to the capex budgets of these two companies. So they're in a really strong position as these companies continue to build out their data center expansion. I mean, that $1 trillion of data center infrastructure that's got to be ripped out and replaced, that is because we've got to see companies transition from general purpose computing to accelerated computing in order to power all of the AI-related software that we all use today.
So, Claire, I feel like you might be watching this show because you also gave us a list of underappreciated tech names. So one of them is one that we spoke about on the show quite a bit yesterday. I'm going to give you the whole list. Tesla, which is surprising to think it's underappreciated, but TSMC, and the last one's Nvidia. So we talked quite a bit about on the show yesterday. Is it overvalued? Is it undervalued? It sounds like you think it's actually undervalued, even though it's trading, according to our system, 37 times forward earnings. We had a guest yesterday correct us and say it's actually 31 times forward earnings. Either way, quite a premium over the S&P that trades at 20 times.
Yeah, so I have around 35 times forward earnings. But I mean, the key point is that Nvidia is still trading on more or less the similar multiple as it was this time last year because the fundamentals of this company continue to move ahead of the stock price.
But who's not appreciating it?
So the market is pricing in for 2024 85% revenue growth. Now, we think that this is conservative. If you take TSMC's revenue guide for their AI-related processors, they're saying that this is going to double this year. Now, that's very significant because this is a very conservative management team. But TSMC probably have the most visibility of anyone on NVIDIA's revenue streams because they see the orders first. So if you apply this guide to NVIDIA's data center business, and even if you factor in a 5 to 10% market share loss to AMD, you get to a revenue growth rate of comfortably above 100% for the year. So we think the market is really underappreciating this AI build-out. NVIDIA is leading on product innovation velocity. Competitors are finding it very hard to catch up.
So your underline is that NVIDIA is actually undervalued?
Yes.
The large AI market has continued gaining traction in 2024 as companies spent huge amounts of money on building up AI infrastructure so that they don't fall behind in the race to deploy and integrate the newest AI applications. According to one estimate, global spending on AI is expected to cross a whopping $200 billion this year, and chipmakers like Nvidia have gotten so many investors rich thanks to this massive splurge. That is why HSBC analyst Frank Lee recently raised his price target for Nvidia stock to a staggering $1,350, and this implies an upside of around 50% from where the stock is trading as of the time of this video. We've seen many analysts saying that Nvidia will definitely cross the $1,000 mark, but despite this, they think that Nvidia stock is still undervalued. So, if you're interested in Nvidia stock, keep watching this video because we're going to walk you through why Lee sees this major upside for Nvidia. Additionally, with Nvidia's Q1 earnings report just around the corner next week, we're going to talk about how they could affect the market and whether investors should buy the stock before earnings or not. But before we do that, if you want to keep up with Nvidia's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates. Now, back to today's video.
Nvidia, I mean, the earnings are looming large. Now we're going to have to wait 12 days or so before we get them. How important a moment is that going to be for the whole market?
It's the biggest name affecting the whole market. I mean, there's no one else bigger. If they tanked, if they stumbled, it would have profound impacts on other names and other sectors that are far away from AI. So there's no question that everyone's looking to them. The Taiwan Semi news, though, of today, and just April sales being up sequentially 21%. For them, and AI chips being a big reason why. I think it, goes back to the story of Nvidia as really the core way to play AI, despite the fact that they've had several good quarters to this point. And so, I just don't think it's going to be a 3-quarter and done story. I think it's a multi-year story, and Nvidia is going to continue to move up from here.
Nvidia is set to report its Q1 results on May 22nd, and analysts expect EPS to skyrocket over 400% to $5.91 a share. Additionally, revenue is expected to reach $24.4 billion, up 240% from the year-ago quarter. With that being said, analysts have continued to raise the bar for Nvidia, especially after the company announced its Blackwell platform for accelerated computing, and one of these analysts is HSBC's Frank Ley. HSBC recently raised its Nvidia stock price target by $300 to $1,350 and also kept a buy rating. Moreover, HSBC sees fiscal 2026 revenue potentially reaching $196 billion. And HSBC isn't the only investment bank that's bullish on Nvidia stock. In fact, UBS recently increased its Nvidia price target to $1,150 from $1,100, citing the impending arrival of its next-generation AI GPUs. UBS is expecting the company to deliver $175 billion in revenue in 2025, which will coincide with its fiscal 2026, along with earnings of $41 per share, and those estimates point towards a massive jump compared to Nvidia's fiscal 2024 revenue of $60.9 billion and $12.96 EPS.
Over $1.2 trillion.
Now, let's say that Nvidia does hit $41 per share in earnings in 2025 and trades at 30 times earnings, in line with the Nasdaq 100 index's earnings multiple. Its stock price could hit $1,230 within a couple of years, which would be a 36% jump from current levels. While this multiple might seem too high for some investors, Alec Young, chief investment strategist at MA Signals, says that Nvidia's growth rate easily justifies this high multiple. Let's hear what he had to say. Hello everyone, and welcome back to Investocracy.
I'm looking at Nvidia trading at about 37 times forward earnings. The S&P, just for context, trading at about 20 times forward earnings. Is it too highly valued?
Hi, Frank. Great to be with you. Well, just to correct your math a little bit, because the details kind of matter to answer your question. NVIDIA is in its fiscal 25 year now, and the street's looking for about $26 in earnings. Next year, calendar year 25, is their fiscal 26, and the street's at about $31. So the PE on 2025, the forward number is actually 31, not 37. And we think, given the growth that they've been putting up, they've been growing about 80% a year. Obviously, for a $2 trillion company, 80% growth is hard to keep up year after year. So that's expected to slow to 20% and then the high teens thereafter. But that type of growth easily justifies a 30-type multiple for a blue chip stock. Microsoft, for example, has that sort of mid-teens growth and trades at 30 times, and people don't seem to be as worried about valuation. So I think the valuation, it's not cheap, but it's certainly not in nosebleed territory. And the market's anticipating that while Nvidia is going to remain a very dominant company, their growth rate is going to slow just from the rule of large numbers over time.
The market for semiconductors powering AI applications is expected to deliver a whopping $341 billion in annual revenue in 2033, and the latest developments in the AI chip market signal that Nvidia, with a market share of over 80%, will remain the best bet for investors who want to capitalize on this tremendous opportunity. Now, some other investors make bets on other semiconductor companies like AMD and Intel, and it's true that AMD is the second largest player in the game, with its newly released AI chips that were well received by big tech customers like Microsoft. However, Nvidia's position as a dominant player isn't likely to change anytime soon. So, let's take a look at why Young believes that Nvidia will continue to hold on to the crown. But first, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Okay. Talk to me about where NVIDIA's position. I mean, I think every company, including the hyperscalers themselves, they want to make the chips that go into these data centers to power AI. How big is NVIDIA's moat right now? How much longer do you see it lasting? Are there any rising competitors? For example, is an AMD, is it a rising competitor?
Sure. Well, I think with NVIDIA, certainly the moat is still pretty wide. That's what's been so amazing with this huge opportunity growing so quickly. They're still garnering, over 80% of these data center GPU chip sales. The biggest challenge they have is that everyone wants the latest and greatest NVIDIA chip. So the N100, it's not going to be coming out until next year. They've talked about Blackwell. So it's really about them being able to make the chips as fast as people want them in terms of innovating quickly enough, and then supply chain issues. So it's really, the demand is extremely strong for NVIDIA. All the issues around how much they can monetize that and how much revenue they can squeeze out of that are around how quickly they can meet that demand, especially around potential supply chain snags. In terms of competitors, I mean, we just got guidance on data center from AMD when they reported earnings about a week ago. They're guiding to something like $4 or $5 billion for next year. To put that in perspective, NVIDIA is doing, 80 billion. So AMD's a great company. They play in a lot of other places besides the data center, like the PCs, for example, where you don't see NVIDIA having nearly as big of a footprint. So it's a broader based company, but in the data center GPU market, they're still a very distant competitor to NVIDIA.
The graphics processor market is projected to grow by 28% annually through 2030, and AI spending across hardware, software, and services is forecast to increase at 37% annually during the same period, which gives Nvidia a good shot at annual earnings growth of around 30% through the end of the decade. With that being said, Wall Street expects the company to grow EPS by 35% annually over the next 3 to 5 years. Now, that makes Nvidia stock look pricey, and that's why there's a huge chance that we will see an Nvidia stock split this year, or even during earnings. Nvidia's last split was in 2021, and at the time, the share price was approaching $800. However, with the current trading levels around $900 per share, this may have ignited another stock split conversation in Nvidia's boardrooms. It's always nice to own more shares after a split, since the reduced per share price means there's room for greater potential price growth, and given Nvidia's history of tremendous growth, this split will attract many new investors. Additionally, a stock split for Nvidia is more likely given the company's emphasis on affordability for investors and the management's prior actions. But does that mean that investors should wait until after a split happens to load up on more Nvidia shares? Well, that depends entirely on what you're looking for. Buying before a split might mean purchasing at a higher per-share price, but you'll own more shares after the split. On the other hand, if you're looking to buy into a stock at a cheaper price, you may want to wait until after the stock split. Even better, you could just spread out your purchases so you don't miss out on any potential gains as you wait for the split, and buy some shares before and some shares after. This goes for earnings as well. A stock's price tends to be volatile during earnings, and we've seen many stocks smashing expectations this year, like Meta and AMD, but still dropping after earnings. So it might be best to spread out your purchases just to be safe. Also, keep in mind that while a split is likely, we don't know if it'll really happen, and Nvidia stock has major upside without it, so buying is a great decision either way. So, what do you think about Nvidia stock? And what are your expectations for Nvidia's future? Let us know your thoughts in the comment section. And don't forget to tell us what your valuation for Nvidia is. If you would like to know more about the latest updates about companies like Nvidia, then go ahead and click on the next video on your screen. See you there.